Hi, everyone. I'm Alex. I'm one of the co-founders of Upshift, one of the vault providers that you'll have probably heard about amongst many others on this stage across the room. So the title of this panel is Security Models Fully On-Chain versus Hybrid. Without getting too into the weeds for the first question, we'd love to hear from the panel. First, how you interpret this title and what you understand by fully hybrid versus fully on-chain.
I can start. I'm Etienne from Mellow. I think it's a topic that is quite important.
Hello, Ioannis and composability like ChainSecurity. Yeah, that's certainly the step. We have contemplated a lot of my colleagues, what models are more interesting and more useful. Are the ones that are the protocols that go full on chain more interesting, or is it that you need always some parts to be off-chain?
Interesting from my perspective.
Hey, I'm Monet. I'm the head of strategy at Spark. I think that it's an interesting kind of dichotomy. In some respects, almost everything in DeFi is sort of hybrid because they use oracles frequently, but there's different levels.
And my name is Nadia, and I am CEO at Lagoon Finance. And the topic is very relevant and important to discuss because I believe there's a lot of misconception. What's fully on-chain, what's hybrid, and what does it actually mean for the end user?
All right, I guess for second question, we can go in the reverse order, but you touched on this briefly. So speaking to Lagoon Finance specifically, what parts of the design is on-chain versus off-chain, and how are you thinking about those trade-offs?
So just to clarify, Lagoon is a vault management infrastructure. What does it mean? So Lagoon provides their users with vaults, API-powered, deploy your vault anywhere, everywhere. So that means that the vault is the product, not the underlying strategy. So we are strategy agnostic. What does a vault do? Well, a vault tokenizes the flows. It tokenizes the subscriptions and redemptions. It helps the owner to set fees and has certain other roles and functions directly linked to the vault. So those elements, which are ultimately two smart contracts, are on-chain.
Are there any considerations where you would restrict something because it's an oracle or constraints that you impose to your clients because of requirements for oracles or compatibility, or some of it might not be you establishing judgment on the risk of the strategy, but just purely technically?
Lagoon protocol is completely agnostic. This is not my call to make.
What about Spark?
So yeah, we kind of sit at an interesting sort of part of this vault infrastructure. We're kind of vertically integrated. So Spark Liquidity Layer is our generalized cross-chain vault infrastructure, but then we also act as the curator, and we're kind of setting the strategies, risk managing all of our different allocations. We definitely lean in on a hybrid architecture because it allows us to be a lot more agile. Previously, MakerDAO, everything had to go through governance, which can take days or weeks. And we still go through governance. Everything's, at the end of the day, it's still owned by governance. So it's non-custodial. It's a fully non-custodial product. But within certain constraints, we have a lot more freedom to make sure the strategy is optimizing for risk-adjusted returns, just be a little more agile overall.
I guess similarly, how does that impact your thinking around deploying to assets that are fully on-chain versus assets that might have centralization risk or an Oracle dependency?
Yeah, I mean, we're, for the right price, we're willing to deploy into a variety of assets. So we, as an example, most of our capital is sitting in Sparkland, which is it's like an AVV3 style lending market, very transparent. Almost everything other than the oracles is fully on chain. It's just kind of plain vanilla. But then we also, previously we've deployed into Athena, which has got it has decent transparency, but it has a lot of off-chain risk factors. Similarly with Maple. And, in the near future, we're exploring some new products where we're basically going to run an off-chain margin engine, which is going to allow a lot more capital efficiency. It's going to unlock a lot of strategies for our users, but then it relies on critical parts of the system that are not existing on chain. So the way that you manage the risk and making sure that it's still non-custodial is definitely a bit different.
Thank you, Ioannis. What about you? How are you approaching, when you look at a code base and a vault design or an Oracle design or a protocol design, the trade-offs between everything being fully priced and fully realized on chain versus security trade-offs there?
Yeah, I find it extremely interesting. So in general, I really like the idea that you have the whole logic on chain and you really don't have many parties that are responsible to react on something that happens on chain. But as the other panelists mentioned, I think it's quite important that we maintain this, agility and this flexibility. So it's really important to have also some kind of infrastructure so you can react in case, you end up, your protocol or your vault ends up to a state that, you didn't expect. Or maybe, the environment shifted so rapidly that, you didn't expect that something would happen. And then I think it's quite important to have someone, off-chain who can react to this and bring the vault, in this case, back to, to a proper state.
And in terms of, having seen probably the most, amongst everybody on here, the most horizontal view of all the smart contracts that you've seen, and we give you access to our GitHub repos and everything else. How do you see the space evolving? Because obviously, back to 2020, we're in a world where Yearn Finance was fully on-chain, right? Like everything was programmable and inspectable. If you're tokenizing stocks, at some point you're touching something off-chain. How is that changing your job?
It changes it a lot because we need to have a better overview of all the components, both the on-chain and the off-chain ones. So this is, something we try, to keep up with because the whole industry changes very quickly. I think that, as the DeFi space matures, people come to realize that it's important to have some off-chain infrastructure as well. And I think it's quite unrealistic to try to have everything on chain, even this is, very attractive for the narrative of your protocol.
Fair enough. What about you? How's Mellow designed?
I guess on the Mellow side, we're a little bit like Lagoon. We're like a neutral infrastructure, and so it's really a matter of what the client wants, what the partner wants. And to give you an idea, we have 60 vaults live on Mellow today, a bit more actually. And so it's highly diverse. We have fully on-chain products, we launched Lido Earn a week ago. They are really picky in terms of security, and so everything is fully on-chain, and kind of you have dashboards, and you can track all the transactions and so on. And at the same time, we're also working with hedge funds, and what they're doing in that case, they are they want obfuscation because there is alpha in what they're doing, and so obviously you don't want these products to be completely composable with DeFi, but at the same time we need these products still. So it's quite interesting and it's highly diverse.
And similarly, realizing that you're fully neutral, do you require certain things to be displayed on your UI? Or I think the past few weeks have shown us, it seems like everybody came out unscathed here on the stage, but that, give me your money on my EOA type of behavior with no proofs of transparency has its limits. So yeah, how are you thinking about those problems?
So it's a good question. And to be clear, today on Mellow, we don't have any kind of off-chain vault live. And I'm pretty sure that the product team will display a big warning.
Fair enough.
They are in the room.
Well, that's how you survive, right? Okay, so as you're thinking about launching those products with more off-chain dependency, how are you thinking about the trust assumptions and how they change? I think, because it seems to me and feel free to wildly disagree with me here, but there is no free lunch, right? If you put everything on chain, somewhere the Oracle is relying on some trust assumption. And so most of the time you're just shifting the risk around, right? Even if you're taking, Lido, you have some reliance on the underlying node operators. At some point, there's a trust assumption somewhere. And so how are you thinking about, as you start moving from fully on-chain to more hybrid models, about the risk there?
Yeah, I think it's a very interesting question, and each vault is unique. It's I guess there is the question of composability. To me, that's the biggest topic. If you build something a bit more trusted, then you are not going to push composability. And this is what we've seen with Stream. As it's fine. I mean, it's fine. I don't know what happened with Stream, to be honest. I'm not involved in any case, but it's a trusted product, and you don't want that product to kind of leak into like various vaults and kind of trap some lenders that were not in the know. And so it's really important when you're building more or less like trusted product to make sure that these products are not going to that are going to be restrained to like a vault and nothing else, not like a tokenized stablecoin-ish. You know?
Yeah, I think it seems like we're also going to, the definition of a stablecoin is going to progressively get more solid over time. Back to ChainSecurity, in terms of those risks, I guess, and having been through one of your audits, like there's different components of the audit, right? Like different types of vulnerability. How are you assessing the economic risk or the trust assumptions in the instance of an off-chain system?
So the economic risk we cannot really assess. What we can really help the client do is really understand what assumptions they have really made for its client, for its party, and we try to help them limit these assumptions as much as this is possible. Because, for example, you might have a party or an EOA, that can completely shut down the system, and maybe you don't even realize that in the first place. So this is one of the things that we really try to do.
Where do you think your responsibility ends as the auditor in terms of, I'm here for the spiky questions, in terms of flagging things and then, they're on the audit report, but making sure that it's communicated?
So I think it's really important to explain to the developer and the people who are going to use the protocol what the risks they're undertaking. I think this is the most important thing you can do. And then, of course, you can help designing the protocol in a better way so, it's a little bit easier for everyone to understand what's going on. And I think this is what we try to also highlight with our reports. So we have a separate section with trust assumptions, just so everyone is able to understand exactly what's going on and what's going to happen even off-chain, potentially.
Fair enough, thank you. On the Spark side, as the risk moves off-chain, and like I actually don't know to what extent you're involved in the RWA subvertical as well, but of Maker. But how are you thinking about making those risks transparent? How liquidity risks change, and the general trust that you build into the system?
Yeah, we're not too deep in RWAs. That's mainly like sort of other sub-DAOs within the Maker ecosystem. But our allocation logic is happening mostly off-chain. So we have, essentially like a allow list of different things we're allowed to allocate into. We've got rate limits and slippage limits. So it's pretty well constrained, even if we went totally rogue or lost our keys or, somebody hacked us for the off-chain component. There's a very well-defined like sort of maximum loss that we can actually calculate that explicitly. So at least for the time being, like we have that pretty well boxed. As we get further into like RWAs, where we're actually delegating our assets to like a fully off-chain managed strategy, the security sort of approach definitely differs a little bit. You have to be checking about their key management and their custody practices, sort of the legal underpinnings of the strategies. It's actually quite a different game. So I think it is going to be challenging for DeFi because it's not something that I think the space is very well tooled up for. And there's going to be a lot of private credit issuers and various asset issuers that are just trying to like stuff products into the people who don't know how to price it. So I think for Spark now, we're not too concerned, but it's going to be an ongoing challenge for the DeFi space to digest these more complicated off-chain products.
On the Lagoon side, I guess your model is most similar to Mellow. So similar question, how are you, as you think about more off-chain assets coming through and being managed via those vaults, I understand that there's many layers of oracles in between, et cetera. How are you thinking about either expanding your product suite or constraints or the risks that you're shifting around?
So I think it's about vault discovery process. We need to make it much clearer and much easier for users to understand what are the underlying risks assumptions, what are the underlying strategies, what is off-chain and what is on-chain, what is fully possible and what is not possible to have on-chain. So Ioannis, back to your point, it's great to say, oh, everything is on-chain, but it really does come with some trade-offs. And as soon as you start to have more and more RWAs coming into the ecosystem, beginning being tokenized and, tokenized equities, bonds, whatever for the financial efficiencies, not everything. It wouldn't even be possible to have everything on-chain. So back to Monet's point. And my key kind of take on this space now, we need to make it easy for users to understand what are the risks assumptions, what is happening in a vault. So who are the vault curators and what are they actually doing? Right now, it's a wild west out there.
Yeah, fair enough. Within that context, you touched a bit on the RWA being tokenized. How are you thinking about, so tokenized stocks and things that trade 24/7 is fine, or at least 5 days a week, but we're seeing more and more of those credit funds or actual hedge funds with quarterly redemption cycles coming on chain. How do you see that being vaultified or putting that into a vault while maintaining the ability for users to understand that there's not immediate liquidity?
I think quarterly redemption cycles are quite normal and standard in TradFi in certain financial products. It really much depends what are you looking at. You can also have funds with yearly, half-yearly redemption cycles, or even if you're a VC fund, like you're waiting 7 years. So this is not unusual. It really depends what you are selling to your end user, and this is where you need to be transparent. I think for hedge funds and for managers, why are they keen to use vaults as an instrument to start taking their flows? Well, it's efficiency. It's operational efficiency at its saving costs. However, if they cannot implement their strategies, if they cannot trade the instruments and the strategies on chain or on even sexes, it's not that interesting. So the value add of a hedge fund is the specific core strategy that they want to sell to their users. Vaults are there to provide operational efficiency.
Touching on that, actually, so in TradFi, you have the fund manager, a fund admin, an auditor. There's a separation between church and state between those people for good reason. And then you have the underlying infrastructure. So shifting gears from the actual talking about ourselves and the individual protocol designs, as you think about, the vault being just the layer that provides operational infrastructure, then some of it, there's some product and front ends on top of it. In some cases, it's fully, abstracted away via white label solutions. As I'm sure you're selling to a bunch of prospective leads, how has your pitch evolved in terms of other services or other service providers that you recommend also being used? Be it the transparency providers, the auditors, the proof of reserves, et cetera, especially as we learned from the past couple weeks. What Etienne, I guess, to start, what are you seeing in the...
Yeah, it's a recurring topic for like maybe 2-3 months, I would say. On the Oracle update to compute the NAV, I think what we're seeing more and more is independent third parties actually providing the service to compute the NAV on behalf of the curator, which I think is we need to do it. It makes sense that self-reporting is a mistake. Nobody does that. As you mentioned, in TradFi, there is like a fund admin and there is a hedge fund, and it's going to be the same in DeFi. It doesn't make sense to keep it that way. And then we also have like the options that is a bit more like DeFi native, where you can go through a service provider like Chainlink, which just announced a CRE, and build like a bit more like flexible but strong with strong trust assumption oracles to compute the NAV of chain while keeping the security of a Chainlink. And so it's it will depend on the vault and what they are looking to achieve there and the complexity.
Fair enough. On the ChainSecurity side, I guess, are you referring to other third-party providers beyond the audit in terms of, I suppose, ongoing security monitoring or verification of all kinds?
Yeah, I guess both. It really depends on, how complex the system is. So for example, for formal verification, it might be needed if you have a very complex system. Unfortunately, we've seen that it's very hard to formally verify the protocols that are currently on chain because the math is quite complex. So, even though, in an ideal world, we would like to be able to do this, in the real world, this doesn't happen. So yeah, another point you touched on, and I think it's very important, is the monitoring. And yeah, we see that more and more clients really reach out to us to get some recommendation on, a monitoring provider, and also, they ask us to sometimes define even what action should be taken should, the alert, goes off. So yeah, this is something that we see evolving more and more as the time goes by.
Thank you. Monet, on your side, same question.
Yeah, I think there's pretty significant benefits to having off-chain logic. I think it's maybe for the DeFi folks, all on-chain is kind of something that we're shooting for. It's something that we assume is always going to be better, but with our own capital allocation strategy, we are able to ingest a lot more prices, different sort of indicators of market health. Typically when you're doing a vault strategy, you want to reallocate funds towards what's yielding higher. But in some cases, if you have a really high utilization in the market, that's actually an indication of market stress and potentially having losses in the future. So yeah, I think in a lot of ways, having this off-chain sort of allocator role frees us up to just have a lot more depth and sort of richness of data that we're ingesting. And not only it makes the sort of strategy velocity a lot faster, but we're also able to operate more safely by being, sort of a hybrid model, partly off-chain, which is, I think, surprising for a lot of people when I talk with them.
Have you been facing more demands for adding transparency tools or adding third-party monitoring services in the past couple of weeks or months?
Yeah, so I mean, the monitoring is something that we've been pursuing ourselves because we don't want to be flying blind. We want to be, basically the first to know if there's some sort of market-moving event or some sort of issue with one of our markets that we're allocating into. So that's something that we're pursuing, and I think we, as we have more robust systems set up, we can use that as part of our pitch to argue that we're a very safe, robust product. So yeah, I think a lot of it's kind of internally driven, but we'll see how it plays into our sales cycles.
What about Nadia? What about you?
What was the question?
What kind of third-party providers are you kind of selling as a package deal or recommending to your curators so that they can add more transparency to their management?
So I can tell you where the demand is, and I can also tell you about the trends. So of course, Oracle, NAV computation, sophisticated NAV computation. I see demand for permission management. So actually having that third independent party to showcase that, it's not one team that manages it all. So what type of protocols do you whitelist? How do you execute new strategies? Where are you as a protocol or as a vault manager? Where can you go? And the third one, probably the very interesting shift in the industry, is the insurance on vaults. So as we all know, it's not quite yet perfect. We've recently seen some blow-ups. So would it be more interesting for depositors, including institutional depositors, to go into some of these yield-bearing vaults when there's an insurance attached to it? And I think insurance providers have a great opportunity here to push vault curators into more disclosures, better disclosures, and higher standards, because otherwise they will not insure them.
It's interesting because I'm excited for one insurance provider to crack the problem, because historically they want to, when the insurance premium is 5% on a 10% yielding asset, then people have a little bit of a problem with it. And so nobody actually wants to put their money where the mouth is. But hopefully we get there. Hopefully we get there. Okay, moving on. As you're thinking about on-chain versus off-chain, do you actually think that, I think Monet touched on that. It seems like the DeFi ethos is that more on-chain is better. But in terms of the way you communicate that to users, obviously this is not viable in the long term. How do you communicate the benefit of off-chain systems and how you're mitigating that risk? Can go to anyone.
I can pop in. I think we actually, at Spark, we could do a better job of explaining how our systems, have sort of on-chain rate limits coupled with off-chain execution and strategy management, and like how that fits together. So that's a story that we're hoping to tell a little more. All of our like the sort of on-chain rate limit stuff, it does go through governance. So it's there for anyone looking, but we're still kind of figuring out how we can surface this information in a way that's more digestible and more understandable. Like, people they really want to know, like, am I going to lose money? And like trying to get as close to that sort of one paragraph understanding that gets people the information they need quickly.
On our side, I guess like one of the topic that I like is that if you put a lot of things on chain, there is a lot of predictability, right? So it's kind of limiting the downside, but at the same time, it's capping the upside, meaning that the universe of possibilities, what might happen into the vault, whether it's like curated or automated. And the vault can be front-run by third parties because it's fully on-chain, right? It's transparent. And so it's a very good design when you're building a protocol on top of a vault, okay? But when you're essentially tokenizing an hedge fund or like vaultifying an hedge fund, then there is a lot of value having like an obfuscation level, because obviously there is edge and there is like a niche skills that you want to leverage, and the fact that it's like completely obfuscated is value, right? It's additional upside, but also potentially additional downside. So we talk a lot about the risk, but it's also, there is two sides on this coin, right? There is risk and there is reward. And to me, like fully on-chain is, like a relatively lower risk, lower upside versus something that includes off-chain components.
You talked about obfuscating. Do you see a world with, it seems like the theme of this Dev Connect is more or less, there's vaults, obviously, but privacy. Are you seeing efforts there in terms of being, for a hedge fund, for an off-chain, any type of asset, being able to, preserve their alpha, but demonstrate that the funds are really what they say they are?
We are starting to look into it on the Mellow side. It's going to take time, but clearly with FHE and DK, you can bring a lot more, obfuscate the strategy while keeping things on chain. And to me, that's the ground. So we need to go there.
Any other opinions on privacy here?
Yeah, I mean, there's pretty clearly demand for strategy privacy. Like one example offhand is Athena. It's a custodial product. They run their strategies mainly on centralized exchanges, but they've set up this proof of reserves, like real-time proof of reserves system. Interestingly, I don't think a lot of people have looked into like how it works specifically, but the people who are testing it, Chaos Labs, Llama Risk, a few others, they do not see Athena's positions because Athena is so concerned about sort of like alpha leakage and people like front running them, or I don't know, various other concerns they have about strategies being leaked out, that they have this whole system of basically running computations within a TEE server to sort of prove that the assets are all there, that they're delta neutral, but without any of the people who are actually attesting that seeing the positions. So what Chaos Labs and these other folks are attesting is that they've reviewed the code and they think that the code is accurately reflecting how the calculation should work. But so essentially there's huge demand for not leaking alpha, I think it, at the margin, it does kind of increase your risk when you're being that private, because it becomes much more difficult to make sure that everyone's being honest and that, the strategy is within the mandate that you expect.
I think there's a difference. So it's a different thing, privacy, and different obfuscation. And I'm really worried, and as security researchers, I think we're really worried about people, of people cutting corners regarding, how they implement these strategies. So I think there is a long way to go. So we build strategies in a way, that they protect the alpha, but still, they're correct and they don't put people's funds in danger.
So what's the big difference when you say obfuscation versus privacy?
I mean, obfuscation is a fuzzy term, I guess. Privacy is a very well-defined term. It's there is some mathematical backing behind it. So yeah, I don't think we should be mixing these two terms, just for the sake of protecting.
And for the sake of the audience, in simple layman terms, what is the right way to frame the problem?
I think we should try to create privacy in a way that it's, that allows algorithms to be implemented in a provable way, in a provably correct way. That's the way we should go, I think.
Okay, interesting. Any other points on privacy, or can I move on? All right. I think as we look to the future, and I think at this point we've covered the topic of things becoming more hybrid. If you had to redesign your protocol or a brand new version of your protocol, be it both vaults or lending, because I think it's a fairly similar problem there. What would you put on chain and what would you put off chain?
Ours is exactly as intended.
All right.
We just released ours, and it's good.
I guess tell me a bit more in terms of how is the V2 better than V1 in that respect?
Much more modular. So you can actually build. We couldn't build hybrid models, hybrid vaults before, and so now we have the ability to do both, and we actually can do both within a single vault. So you can move towards like more hybridness and more fully on-chain-ness depending on the current market. It brings a lot more flexibility to the curator or the asset manager behind the scene.
What about you, Monet?
So actually, Spark is, we run our strategies on a homemade infrastructure, a Spark liquidity layer. We're working on a V2, which is, the main benefit there is just kind of more modular and more reusable parts, so that as we, Sky ecosystem has more sub-DAOs, we're not relying on everyone kind of like home baking their own modifications to it whenever they want to support a new protocol. So we're excited about that. I'm not a dev, but my sort of maybe uneducated vibes-based answer would be, I think in many respects, you want as little as possible to be on chain of the business logic. I was a little bit shook from the balancer V2 hack, which like that protocol had been on mainnet for years. And yeah, I just think that like the bare minimum that you need to make sure that your system is non-custodial, keeping that on chain, and then any of the complicated business logic, if it's off chain, but you still have those guardrails, if it breaks, like you can have like a well-defined amount that you're losing and then just kind of recover the system as soon as you can. So yeah, I think simplicity on chain and then complexity off chain.
Okay, as we're getting towards the end here, I have one two-part question to finish. As the world gets more modular, it also becomes harder to track. So number one, what is the risk that keeps you up at night as part of DeFi? And obviously, your infrastructure might be permissionless and might be neutral. Nobody likes somebody blowing up on as one of our curators blowing up. So yeah, what keeps you up at night? And then what are you most excited about 2026?
To take this?
Go for it.
I think the biggest risk is, you have, as you mentioned, you have many modular systems which compose with each other. So maybe you have behaviors, that you don't expect, because the state space is the multiplication of the possible states of all the protocols that participate, in the flow of the execution. So I think this is what keeps everyone at ChainSecurity up at night. As for what I'm the most excited about, so for security, for sure, one of the things that we're very excited about is privacy, and all these new opportunities we have, to learn more about, how systems are built in a privacy-preserving way, while having some, mathematical guarantees behind them.
I would say bad access and misrepresentation of products, misrepresentations of vaults, lack of transparency. It's fine that you implement a degen strategy and take 20x leverage. You just have to put it on the front page, put it on the label. That gives me a headache.
What are you excited about? What are you excited about?
I'm excited about increase of standards, transparency. I'm excited about the new generation of assets coming on chain, RWAs coming on chain.
Monet?
Yeah, a couple things keeping me up at night, but so one aspect, which is kind of a unique feature of Spark, is we exist within the Sky ecosystem. Right now, we're one of basically two sub-DAOs, us and Grove, and I trust our strategies. I know the Grove folks well; they're super reliable. But as we have more and more of these new sub-DAOs coming up, we're kind of like all in one boat. So, like, if any one sub-DAO has a strategy that does not work, they can sink all of us. So, as you know, we're all kind of going to be using like hybrid strategies, but I think, as a whole ecosystem, we really need to lock down the transparency aspects, the risk management aspects, and just make sure that everyone is taking risks that the whole system should be comfortable with. Because again, we can be doing everything right, but we need all of the other, sub-DAOs to also be operating reliably. So I think that's the main concern I have is, and then also just kind of more generally, kind of market spoiling. If we have another Terra Luna event, suddenly every DeFi stablecoin or vault is gonna, we had a little bit of this, this past week. I think a lot of well-managed vault providers took heat. They saw some AUM outflows because someone else that they had nothing to do with did a bad job. So that's a cause for concern. I think, industry-wide standards are gonna help a lot with that. As far as excitement, I think that, once we have this vault, all of our sort of next level vault infrastructures online, the strategy velocity is going to improve a lot. The type of things that we're going to be able to access and do in a non-custodial manner are, kind of continually expanding. So it's just going to make us way more competitive with TradFi, structured credit and yield products. And I think, we're going to be at a significant advantage versus TradFi, sort of fund infrastructures, and that's going to be great.
Etienne?
I guess what worries me is this tendency in the space to make all the assets composable with anything, even when they are trusted setups. And as you know, we are building money Legos, and so if you put a trusted setup as a pillar of DeFi, then everything just falls down. And so it's very, very important when, especially in lending markets, when you're building something that is going to be used by other asset issuers, by other protocols, building other bricks on top, to really be picky in terms of what are the trust assumptions of these assets, and what are the risk of bad debts, and so on, and acts. And then what excites me, so Ioannis, you pick privacy, so I have to find something else now. But I guess we're at the Vault Summit hosted by Morpho, so I would say maybe the DeFi mallet is something that excites me a lot. We see all the custodians, doing RFPs to integrate vaults. It's going to end up in fintechs, front ends, and so that's I believe a big growth vector for us.
All right. I think that's all the questions I had. Thank you, everybody.